Listen to me. You have worked hard your entire life. You saved, you sacrificed, you did everything you were told to do so that one day you could cross that retirement finish line and finally breathe a sigh of relief. But I am here to warn you today that there is a silent partner waiting for you at that finish line, and if you are not careful, they are going to take a massive, painful bite out of your hard-earned freedom. I am talking about Uncle Sam. The biggest mistake I see people make as they approach their 60s and 70s is assuming that because they are no longer working, their tax problems are over. They think, oh, my income will drop, so my taxes will drop too. That is a lie, and it is a dangerous trap that is causing thousands of retirees to live in regret, watching their retirement accounts bleed out faster than they ever imagined. Today, we are going to look truth in the face. We are going to break down the 4 absolute biggest tax retirement regrets so that you can protect what is yours, because you deserve to keep every single cent you worked so hard to build. Let's start with regret number 1, and this one makes me so angry because it catches people completely off guard, the crushing shock of the Social Security tax torpedo. You have been paying into Social Security with every single paycheck since you were a teenager. You think that money belongs to you, free and clear. But did you know that up to 85% of your Social Security benefits can be taxed by the federal government? Yes, you heard me right, 85%. Here is how the trap springs shut. The IRS looks at something called your combined income. That is your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits. If you are single and that number is just over $25,000, or if you are married and it is just over $32,000, they start taxing your benefits. And those thresholds? They haven't been adjusted for inflation in decades. So, what happens? You think you are doing the right thing by taking a little extra money out of your traditional 401k or IRA to take a vacation or fix up the house, and boom! You accidentally push your combined income over the limit. Suddenly, you aren't just paying tax on that IRA withdrawal, you have triggered a domino effect that makes your Social Security taxable too. It is a double tax penalty driven by fear and a lack of planning. The question you have to ask yourself right now is, do you think tax rates are going to be lower or higher in the future? Look at the national debt. Look at the state of the economy. If you think taxes are going up, then leaving all your money in a tax-deferred account is a ticking time bomb. The day you go to withdraw $50,000 for your living expenses, you realize you actually have to pull out $65,000 just to pay the ordinary income tax on it. You are draining your principal out of fear of paying taxes today, only to pay massive taxes tomorrow. You need to fix this before it is too late. Your actionable takeaway is to start implementing a Roth conversion strategy during your lower income years, specifically that beautiful window between the day you retire and the day you are forced to take distributions. Move pieces of your traditional accounts into a Roth IRA over time. Yes, you will pay tax on the converted amount now, but you are paying it at today's known rates so that your money can grow tax-free and come out entirely tax-free later. That is how you take control. That is how you power protect your future. Now, let's talk about regret number 3, and this is the monster hiding under the bed for anyone over 70, the devastating penalty of ignoring required minimum distributions, or RMDs. For years, you get to choose when to take your money. But when you hit age 73, or age 75 if you were born in 1960 or later, the federal government stands up and says, time's up. We want our tax money, and we want it now. They force you to take a specific amount out of your traditional retirement accounts every single year, whether you need it to live on or not. The problem here is twofold. First, if you miss an RMD or miscalculate the amount, the penalty is severe, up to 25% of the amount you were supposed to take but didn't. Think about that. Giving a quarter of your retirement income to the government because of a calendar mistake? It is a horrific, avoidable tragedy. Finally, regret number 4, waiting until you are already retired to start planning your tax withdrawal sequence. Most people think retirement planning stops the day you retire. No! That is just phase 1. Phase 2 is deciding which bucket of money to empty first. Do you pull from your cash savings? Your taxable brokerage accounts? Your traditional accounts? Or your Roth accounts? If you just wing it and pull from whatever account is easiest, you are making a devastating mistake. Many retirees pull from their taxable accounts first because they want to let their retirement accounts grow. But then they turn 73, their massive RMDs kick in alongside their Social Security and a pension, and they find themselves in the highest tax bracket of their entire life. They are completely slammed by taxes at an age when they should be enjoying peace of mind. The fear of paying a little tax early on causes them to pay a fortune later. The actionable takeaway is that you must orchestrate your withdrawals dynamically every single year. You want to fill up the lowest tax brackets first. Pull a little from your traditional accounts to max out the 10% or 12% brackets, use your Roth accounts to supplement the rest of your lifestyle tax-free, and keep a cash buffer so you never have to sell investments and trigger capital gains during a market downturn. Please, hear me on this. Retirement is not just about how much money you accumulate. It is about how much money you get to keep. Don't let these 4 tax regrets steal the life you have earned. Be strong, be smart, and take control of your financial destiny today.